Lump sum investing or dollar cost averaging? Which one is better? And where's my microphone? Because I don't think this is it. Lump sum investing means you buy your whole investment right now. That means if you want 100 shares, you buy 100 shares. Dollar cost averaging is the opposite. You buy 10 shares or 5 shares a month until you hit your goal. And there are pros and cons to both. With lump sum investing, you have the potential for higher returns. And you'll also benefit from compounding a lot more if you have 100 shares earning a dividend versus, say, 10 shares earning a dividend. Another benefit of lump sum investing is you get it out of the way. A lot of people are just casual investors and they don't really want to be bothered with having to go on every month and buying 10 more shares or 5 more shares. They just want to buy it and get it over with. Lump sum investing is also fairly expensive. You have to have all that capital ready to buy the whole position up front. And with some expensive stocks like Netflix and Apple and Tesla, it can be pretty costly. This is where dollar cost averaging comes into play. On the downside, you don't benefit from compounding right away, but for many, it's a much more affordable option. Another very important thing to consider is what's going on with the overall markets. If we're in a very choppy market or a bear market, dollar cost averaging might be a better strategy. But it is key that if you're dollar cost averaging in a choppy or down market, that you are buying quality investments. A lot of stuff won't recover. The last thing you want to do is throw your hard-earned money into lousy stocks. They have to be quality, and even still, they might take a very long time to recover. I mean, imagine buying 100 shares of a company that was like $200 and it drops to $150 in a bear market and you have no money left because you lump sum invested. Now imagine, on the other hand, that we're in a very strong bull market and everything is going up every month. And this bull market could go on for years. Instead of dollar cost averaging down in a bear market, you could be dollar cost averaging up in a bull market. So you could buy 10 shares of a company at $200, and the next month it could be $215. And the third month it could be $225. And then they could have earnings and it could go to $270. In that case, lump sum is the way to go.